And also you're taught in the stock market, high risk creates high returns. Well, that's the financial institutions telling you to take all the risk while they take none of it. Because if you think about who's smarter, banks and financial institutions have got it figured out. And what they would tell us is, hey, well, the number one investor in the stock market are banks and financial institutions. Well, that's where they put their money, so you should too. But the truth is, it's actually your money that you put with the institution, and they just put your money in there, letting you take all the risk. If money's lost, it's your money lost, not theirs. Whether you make money or not, they're always pulling out that consistent cash flow, right? They're pulling out those consistent fees to make that spread. That's where they make their money. They get paid more and more money because they get paid a percentage of assets under management. If you just think about it, it's just all marketing. It's just all sales for them to keep increasing their profits while you are gambling your money and putting all your money at risk.
You're listening to the Gorilla State Investing Podcast. We're not here to bruise your bananas with guru sales pitches, overrated fluff, or any other kind of monkey business. We simply provide the ground-pounding truth about what it takes to be successful in real estate.
All right, Gorillas, today's host or today's podcast guest is Chris Miles from Mapleton, Utah. Chris is the CEO of Cash Flow and Cash Flow Expert at moneyripples.com. He's also got his own podcast with about close to 600 episodes, and that's the Chris Miles Money Show. He's a financial coach and author. He's actually co-authored with Timothy Ferriss. Entrepreneurs on Fire is the book, and also has an ebook, Beyond Rice and Beans. Chris has done real estate investments all the way from flips to turnkey investments. He's done investments in commodities and oil and gas. Chris, welcome to the show. Happy to have you, bro. How you doing today?
Doing great, man. Excited to be here.
Well, so what I want you to do is I kind of gave you the wave top intro, but why don't you go ahead and elaborate a little bit on some of the investments that you've done, kind of where you got started out and where you are today.
Yeah, I started out with very little financial education. In fact, 20 years ago, I was planning on trying to start some business. I wasn't sure what to do, and the first business opportunity that came along was becoming a financial advisor. And I didn't know it was so easy to do that. Like I thought, financial advisor had to be, smart, maybe a major in economics in college or finance, and I was a sociology major with a triple minor in psychology, ballroom dancing, and Japanese. So. I wasn't exactly the guy that would fit the mold, but so I thought, hey, maybe I could learn something about money by becoming a financial advisor. And I did that for 4 years, right? I love being an entrepreneur because I think that's one of the best investments you could ever do is having an actual business of sorts, even if it's a side hustle, But I'll tell you, after 4 years, I realized that people really, I like evidence. I like to know that things work. And when I realized that people weren't becoming financially free, I thought, okay, this is not good. because I'm trying to sell this. Like this is becoming my career. And I'm realizing that now there's like a 0% success rate. And what ended up happening is, of course, when the student's ready, the teacher appears because again, your pocketbook's tied to it. You have this, like your heart's at war. You're not really sure what to do. Well, one of the guys I trained to be a financial advisor left to go do real estate investing. And I remember it was just like yesterday, my friend Doug, I call him up to wish him Merry Christmas. And I thought, I wonder if he's going broke yet. So I call him up to see just how broke he is and see if he'll come back to work for me as a financial advisor. Well, I get the opposite response. He says, Chris, things are amazing. My dad and I, we've partnered on some deals and we've already doubled his income as a professor at the local university.
Wow.
And I said, wait, come on. That's too good to be true. You just started 4 months ago. There's no way that's possible. He's like, it's happening. It's legit. And so we get in this argument about what's better, stocks or real estate, because up to that point, my experience was only been mutual funds, right? And a little bit of stock trading and things like that. I actually had become a stock coach the year prior too. So I was all stock market, right?
Yeah.
Well, I mean, finally he just stopped me. He said, Chris, how many of your clients are actually financially free where they don't worry about money? And I said, well, not worry about money? None of them. Because even the retired doctors, they watch CNN. And if you watch CNN, you're going to worry about everything. Like the sky is falling if you watch those kind of media networks, right? So he said, all right, well, great job not helping anybody, Chris. How about this?
Sounds like a good friend.
I know. Oh, he's awesome. Like I I can't tell you how grateful I am for him, because he gave me that little slap in the face. Because the next question he asked was, well, how many of you guys as financial advisors are financially free? Not off the commissions you're earning, not off all the renewals and everything that you make off the products you've been selling, but actually doing this investing in mutual funds. And as I thought about it, I realized, wait, there's guys that have been in my office since the late 70s, 40 years in this business, and they're still working.
Yeah.
And remember, we're telling people 30 or 40 years you can retire. Well, they can't even retire. So I said, well, none
Jesus.
of them are financially free either. He said, well, there's your problem. I said, well, then tell me what the answer is. He's like, I'm not going to tell you the answer. You just got done arguing with me, Chris. Come on. I said, no, seriously, tell me the answer. He says, okay, if you're really serious, and I don't think you are, I love his little pull away reverse psychology.
Yeah.
He says, if you're really serious, go get this book, Who Took My Money by Robert Kiyosaki, which basically says mutual funds suck, right?
Yeah. Yeah, it does.
And then listen to this radio show that these two real estate investors were doing locally on AM talk radio. And so I did. I started listening to these guys. And the funny thing is, these guys didn't really get into strategy at all. They just talked about basic principles of, everything from money and even like politics and things like that. Like they were obviously very libertarian leaning and things of that nature. And so after a few months, I realized, I said, I got to make a choice here. Like I can either keep trying to be a financial advisor, and my heart will be even more at war, because now I know it doesn't work. So either I keep doing this or I stay in integrity and I quit. And so I finally just said, all right, that's it. I don't care if I'm at the height of my business, I'm quitting. I will just be a mortgage broker and I'll teach ballroom dancing on the side. And so that's what I did. I started doing that. And, but of course, I wanted to know what these guys knew. It was driving me nuts that some of these guys were younger than I were. Some were in their 20s, financially independent. I said, well, I want to do that too. And eventually I started to learn what they did and focus on changing my mindset around, getting away from that traditional mainstream financial advice of accumulation mentality.
Yeah.
And instead I switched to more cash flow, passive income mentality, right? Whereas I like to say accumulation versus acceleration.
Yeah.
And when I sort of switched to that, then all of a sudden, like everything became possible, right? Because, before, think of the traditional way, right? Again, like I'm kind of trying to answer your question in a roundabout way, because again, it was always mutual funds and stocks. But in the mutual fund and stock world, from a financial advisor standpoint, they tell you that whole 4% rule, where, 4%, you live on 4% of your assets. Well, even 20 years ago, we were all questioning that as financial advisors. We're saying, is 4% too high? Maybe it should be 2 or 3%. Funny enough, Wall Street Journal just in October 2021 said, hey, you know what? We found out the 4% rule is too big. It needs to be smaller, like around 3%. So Wall Street Journal is almost as smart as me. Apparently they just finally caught up to the times.
Yeah, we'll get there.
But think about this. I mean, even if you happen to save up $1 million in the stock market, right, in mutual funds, and then you live on 3%, that's $30,000 a year.
Yeah. And
then you get taxed on that $30,000. You are in the poverty as a millionaire. You're basically a broke millionaire if you think about it. And that was the thing that was wrong. I was having a hard time with. Plus, I was having a hard time with the fact that the stock market, really, if you look at the real rate of return of the S&P 500, not what they say is the average, right? Because they do the averages all based on, like for example, if you've ever heard about how average and actual returns are not the same, where like if you lose 50% in your portfolio, you don't need a 50% to gain it back again. Because if you only gain 50%, you only get up to 75% of where you were.
Right.
You have to get 100% rate of return to get back to zero, right? Because you lose half, then you got to double that half to get back to zero. Well, if you do the average of that, minus 50 plus 100, that's 50 divided by 2 years. That's a 25% average rate of return. And so I was teaching those averages, and I realized, well, what's the actual return of the S&P? And it wasn't 10 or 12% like they always taught us. It is like, as of right now, roughly about 8.4%. And that's after the last 13 years of uptrend in the market, right? So half of those, years were just like the last 13, where it was like 14% average. Yet we've still only averaged about 8. Usually it's only about 7 or 8%. So you take out all the fees and everything, you're likely to make 7%. You start putting that in a compound interest calculator, seeing the total number, factor in inflation not being 2 or 3%, like everybody says. We know it's more like 5+%.
Yeah.
But even if you put a 4% inflation rate, you put that in the calculator as a financial advisor, you start to realize, dang, it's pretty depressing. This is why people aren't retiring, because it's just not enough, because the return on the market's not as high as they say, and inflation's higher than they say. And what happens is you're not making that much money. So whatever you save, even like a 401ks, when people trying to get matches, whatever you save in that 401k is about what you can live on each year. So if you're max funding your 401k of 20 grand a year, you're going to be able to live on 20 grand a year, assuming everything goes normal, right? That's just not good enough. And so when I realized that, that's why I said I had to quit. I couldn't just keep teaching this stuff and realize it was just a big lie. Well, when I got into the real estate world and realized, wait, what if I only made 1% a month on a property, right?
Yeah.
Well, that just changed everything, because now that $1 million, 1% a month, that's $10,000 a month, not $2,500 before you get taxed on that. I could be getting $10,000 a month and keeping most of that because of all the depreciation and everything. So I'm making like now more than 4 times the amount of money with the same money. And that whole mindset shift of cash flow and passive income versus just accumulating and then living on less than the interest, it just changed my world, and realized that there was actually hope. And that's why 2007 I started coming out of that and teaching people how to do that kind of stuff. And yeah, now I do all kinds of stuff. I invest in things like, turnkey real estate. I do different syndications, whether it's like with apartments, self-storage, that kind of thing. I even do some partnerships with some guys that do raw land, like flipping and seller financing and things like that. Oil and gas, like some of the things like in syndications that way. But I'm really just more a passive investor now. Like I don't do any of the active investing anymore.
So there's a lot there, and I want to break down some of the things that you discussed so that our listeners can kind of wrap their head around and make it tangible. But the first thing I want to say is it sounds like the old quote, look for the vice and advice, right? So like a financial advisor, and not all financial advisors are the same, but I have noticed in some of the financial advisors that I've talked to, like you said, they're not financially free. So like, what advice am I taking from somebody who's not gone through it and doesn't understand what they're really telling me? Like all these numbers look great on a spreadsheet, sure. But the reality of it is like for you to be financially free, there's a time element involved, meaning that how much of my time what's my return on time? And whereas mutual funds and stocks and stuff like that are passive, there are passive options in real estate, and real estate in my mind gets a higher return and has what I call the 5 pillars of wealth in real estate, where you can get cash flow, but because of your leverage, you can get principal pay down, you get tax benefits, you get appreciation that the market gives you, which the stock market gives you appreciation too, hopefully. But the biggest one, and to me, and correct me if I'm wrong, or if I'm, because I don't know a lot about stocks and bonds and stuff like that, is the fact that if you've got $1 million and you go and you want to look at stocks versus real estate, if you get $1 million worth of stocks, you got $1 million worth of stocks. If you got $1 million, you can go to the bank and get $5 million worth of real estate. And you're going to owe a mortgage on that, but you have to do the math and say, can I cash flow after my debt services? And once you start doing the math on it, you're getting you're getting a lot better dividends than you are in the stock market. And it's just not as susceptible to let's say something crazy happens, like Ukraine gets invaded and the stock market starts to crash. Well, our renters are still paying rent over here in the United States. So what would be your key takeaway from stock markets versus real estate? What would you say would be the argument for real estate or stocks, whichever one?
Yeah, I mean, the only argument I would say for stocks or mutual funds that are good is that they can be liquidated fast, right? Like where real estate, that's the one, slight disadvantage is that it might take a few months, maybe. I mean, in this market, it hasn't been that hard, but it might take a little time to liquidate something. But with stocks and stocks and mutual funds, you can sell them that day, right? I'd say that's the advantage. That's probably about it. In truth, I mean, really with stocks and mutual funds, they don't have any tax advantages. That's the one thing I noticed when I was a stock coach, an options trader coach. We were teaching people how to do this, but people try to trade inside their IRAs and self-direct, but still at the end of the day, you got taxed on that stuff. You really didn't get a benefit. I mean, yeah, I put into a Roth, but then you're tied down with all the 59 and a half age rules and, 10% early withdrawals and all that kind of junk, right? It's just not great. And also you're taught in the stock market, high risk creates high returns. Well, that's the financial institutions telling you to take all the risk while they take none of it. Because if you think about who's smarter, banks and financial institutions have got it figured out, right? Because they're telling you to take high risks because they let you put your money in the market. They don't put their own money in the market. You don't see. I remember that was a lie I taught as a financial advisor. I didn't know it was a lie. That's what I was taught by other financial advisors, which that's really how it works. Financial institutions teach financial advisors to tell you how to sell for those financial institutions, right? That's really what it is, not financial advice. Yeah. It's just financial sales. And what they would tell us is, hey, well, the number one investor in the stock market are banks and financial institutions. Well, that's where they put their money, so you should too. But the truth is, it's actually your money that you put with the institution, and they just put your money in there, letting you take all the risk. So if money's lost, it's your money lost, not theirs. They're always taking out their 1-2% or so of fees that they're pulling out all the time. Whether you make money or not, they're always pulling out that consistent cash flow, right? They're pulling out those consistent fees to make that spread. That's where they make their money. So of course they want to tell you to keep it in there forever. They'll tell you to keep it in there for the long haul, pull out less than the interest. Why? Because if you keep letting your accounts build up over time, they get paid more and more money because they get paid a percentage of assets under management. So if you just think about it, it's just all marketing. It's just all sales for them to keep increasing their profits while you are gambling your money and putting all your money at risk. The truth is high risk does not create high return, because if high risk created high return, think about it. Definition of risk is chance of loss. What's your percentage chance of losing? Well, if you have a 90% chance of losing, would that imply that now we have a 90% chance of winning? Like that math doesn't add up, does it?
Chance, yeah.
Exactly. Like this is common sense. That's a great thing about finances, right? The more common sense you use, the smarter you are. If you try to listen to financial advice and get all, try to get all, smart, all woke, so to speak, in the financial space, you really just aren't. You're actually an idiot, a total idiot. The more you're trained in financial advising, the more dumb you are. And that's the problem. And so, yeah, it's not that way. But see, with real estate, I've learned that the lower the risk, the higher the returns, right? I don't want to take high risks. I want to take low risk, managed risk to get the best returns possible. And you can do that with real estate.
Absolutely. And that's one thing. Well, when I talk to people, and I'm not a financial advisor, but I do give financial advice. I'm in the military. I got a lot of junior sailors that'll come up to me because they see the stuff that we're doing and they, hey man, I want to talk to you about investing. And one of the first things that I'll do to anybody is tell them, if you even read Rich Dad Poor Dad, and if you haven't, we can't even have a conversation. We're on the same plane until you've got an outlook on finances that I don't have to break all these bad habits in a 1 hour conversation. And usually when the ones that when they come back to me, their eyes are opened up like, man, I've got like this institutional way of looking at money, which is, everybody talks about it, get a good education, get a good job, save, retire, put some money away in your 401k or thrift savings plan, whatever it is. And hopefully by the end of your labor years, when you reach 60 or 70, you can start pulling off of subsidies from the government, Social Security, and live off your 401k. But the reality of it is, to me, the riskiest thing that you can do is nothing but that. That's the riskiest thing. You're guaranteed, unless you've got a trust fund or you've got family assets or something, somebody else has done what we're talking about doing that set you up. If all you do is work, save, then you're going to retire and live in a way that is not as good as you're living right now. As far as like your ability to purchase things, your lifestyle. Yeah. So the riskiest thing to me is to do nothing. But everything, like I said, I'm in the military, dude. We do risky stuff all the time, but doing risky stuff carefully is different than being risky, right? It's managed risk. It's mitigating risk, and education is your hedge against risk for sure. but taking zero action because you're scared is going to be the riskiest thing that you can do, because you don't get any way forward. So if you had like erase everything that you told people as a financial advisor, and now we've got Chris Miles years later, the wisdom that you have now, if you were talking to somebody who's just getting started out and say they've got some savings, like $50 to $100,000 in the account, which direction would you push them in?
It's tough. I mean, because, you don't want to give advice, right? You don't want to we'll put a disclaimer, like there's no, we're not giving investment advice right now. Right. But, somewhere to start out, I would start out with the easiest point of entry, right? Like what's the easiest thing to do? Definitely the least risky way would be, and I say this with a disclaimer, of course, because the least risky way, in my opinion, would be like buying your own property, right? But I put the disclaimer on that because most of the time when I see people that do that, they buy a property in their own backyard. And it's usually the crappiest cash flowing type property. They try to manage it themselves, which is what I did. I did the same thing. I made that mistake and it was just horrible. It was a horrible experience. I actually like to find, properties through, companies. Like I like to use turnkey companies, for example, that are in different markets. Find a market that's actually got good, steady, consistent cash flow of at least double-digit returns, like cash on cash returns, meaning that, for example, a 12% cash on cash return means that you make 1% a month. So if you put a $30,000 down payment on a property, that would mean you're making net profit after paying the property manager, paying your mortgage payment and taxes, insurance and everything. You still walk away with $300 a month profit, right?
Yeah.
That's what it should be doing. Then great, go for something like that. And the great thing is you get all the depreciation, so you're not paying taxes on that money. You get to keep all that money coming in. And so if you got $50,000, great. Maybe you can make $500 a month off that and get that start and then keep reinvesting. I think that's the least risky way to go. Now, again, that being said, you have more control. That's part of the reason I think it has less risk, because you have more control. There's no degrees of separation with you and the investment. You are there, you can call the shots. Now, not far behind, I would look at things like syndications too. Now if you only have $50,000 and the syndication minimum is $50,000, you probably shouldn't put it all there, right?
Yeah.
Like you probably want to keep your money a little bit diversified still, or build up a little bit more cash so you have a little bit more. But I mean, that's another option too, where again, now you're hands off. Find an operator that actually has been doing this for years, ideally. Somebody who's been through the thick and the thin. They've got their their knees scraped a few times, and they've seen what happens when they have to pivot with different markets, and they've got a good system and a good checklist that they go through to make sure that the property is good. It's like if you say you're buying into an apartment building, that's great, and you can still get some of those tax benefits, and now you don't have any of the work, you don't have any of the headaches you might get with having a rental property. But yeah, I'd say if you're going to start somewhere, maybe just start with a rental, like a good, profitable cash flowing rental. Like not like what I see out in the western half of the United States here, where they kind of suck.
Yeah, I live out in San Diego, and the way I see it, any NFL city, any city that has an NFL team in it is typically your tier one, your markets, right? So you're not going to get it's big equity plays. Everything's too expensive to actually cash flow. The 1% rule, and I'm glad you brought that up. The 1% rule is kind of a standard across real estate investing, as if it meets 1%, it's worth looking into doing. I try to get everybody tries to get more percent. I try to get around 1.5% and not much more than that. Because what I'll tell you that I've seen is if you're finding 2% deals in today's market, something's probably wrong with it. There is such thing as too good to be true. And what I've seen is if a property's producing 2% a month based on what your down payment would be, it's typically because the expenses have been deferred, which means the maintenance has been deferred, and you're going to buy it. It will cash flow. It'll cash flow nice, but your capital expenditures, meaning roof getting replaced, AC that's been changed out, it's getting replaced, is going to eat away at that. And by the end of the year, you're going to look a lot closer to 1% because all the money you had to put into the maintenance. And so I agree with that. The 1% rule is easy. It's tangible. It's something people can walk away with and say, all right, how do I bar napkin underwrite this piece of property. And that's how you got started. It's how I got started. I got started out with like a house hack, and back then it wasn't really called a house hack. It was just, buying a multifamily and living in it. And that got me started. My next property was a duplex in the hood, and it cash flowed nice. It didn't have a lot of deferred maintenance. It worked well. And that got the ball rolling to where now I'm on the general partnership side of syndications. We're buying RV parks, we're buying hotels. None of that would have happened had I not bought my first property, right? Made the decision that rental income is real, it's beneficial, and I need to take this leap into it, right? Because I did the stocks. I should say I did mutual funds. I bought mutual funds right in 2008, right? Luckily, I didn't have a whole lot of money, like $5,000. And then after 3-4 years, I was like, dude, I didn't make any money. I lost money. This isn't cool, right? But yeah, so and that was who it was telling me I should do that? A financial advisor.
That's right. The person that makes money when you do it.
Yeah, he made his money off my sell. I mean, I'm sure he had plenty of problems after that. It was 2008, hit everybody pretty hard. But were you investing in real estate in 2008?
I was. Yeah. I mean, I got my butt kicked big time. It's funny because I was able to be financially independent in 2006, right? And then 2007, I thought I had the Midas touch, that everything I touched turned to gold. And so the ego and the pride came in, and then, almost you put blinders on a little bit when you get to that euphoric state. And so I remember 2007, it was getting to a point where I just launched a new business with some partners. We're teaching people how to get out of the rat race,
Yeah.
And then at that point, I started to realize that, things were starting to dry up, right about middle of 2007, because real estate got hit hard. We felt it first in middle of 2007 because banks tightened everything up. They started restricting lending all of a sudden. We're like, well, that's weird. And I remember trying to do a cash out refinance. So here's one mistake I made. Again, going back to that traditional financial advisor, Dave Ramsey method, right? Not you Ramsey method, but the Dave Ramsey method, right?
Yeah.
Where the Dave Ramsey method says, hey, load up your mutual funds, pay down your house. So I knew I had equity in my house because I was paying down the mortgage and stuff. I even put a good chunk in there. I even got it to appreciate by building out the basement and everything. So now we have more square footage. And I thought I was the smartest guy in the world because I had all this instant equity in the house I just bought the year prior. Well, the problem is that I was thinking in my mind, well, I can just get a HELOC whenever I need cash equity. So cool, I'm just building up equity in this house. I can get it out when I need it. Not true. Not when things happen in the credit market. So they tightened everything up, and they didn't give us warning either. I remember trying to apply for a mortgage. They said, you know what? If you get your score up 2 more points, we'll do it next month. So I did. And I remember the next month, got my score up beyond the 2 points. And they said, great. But you know what? Just last week, we made some updates and some other additional requirements we need you to meet. So do all these requirements. And then, the next month, we'll see if your credit's still good, and we'll do it. So I did everything they asked. The next month, they said, we're sorry, we're not doing cash out refinances anymore.
Something's changed.
Something's changed here. Right?
Something brewing.
That was September of 2007. I mean, most people talk about 2008, 2009, but we were starting to feel it already. And then I talking to other real estate investors, they're saying, yeah, I'm having issues. I can't do the flipping, and I can't do flips as easy anymore and stuff like that. And then everything just locked up. As a result, I actually lost all the equity in that property, ended up having to foreclose on it because they wouldn't even take a short sale because they were Lehman Brothers. And Lehman Brothers were like, no, we'll foreclose before we ever do a short sale. So all the logic was gone. And I ended up being in the hole between the business, because we were focused on real estate investors. Their cash was gone. And so our business was drying up with all the expenses we had there, and I had expenses at home because all my income was tied up there. I cut off a lot of my streams of income to do that new business, which was a dumb thing you should never do, is cut off your multiple streams of income. And I found myself in the hole $16,000 a month that I was short. And I went from millionaire to upside down millionaire within about a year or so. So 2008, yeah, I mean, I was letting go all my properties. I was selling off everything. I turned in my Mercedes. I said, here, I'm not going to be making any more payments. You're going to take it anyways. Just take it. Yeah. And they auctioned off for $30,000 less than what I bought it for, or what I had a loan on it for. That wasn't fun because then they're calling me up, calling for collection, saying, hey, can you pay the 30,000? No, I wouldn't have turned it in. Well, can you pay $1,200 a month? I said, you realize my payment was $1,100 a month. If I could have kept doing this, I would have kept it. So I was losing everything. I didn't file for bankruptcy, but I was, that close. And so I ended up having to dig out of that hole. It took me a while. I had to pay off over $1 million of debt and get myself built back up again. I had no credit, no money. My credit was like a 480 after all that crap going on. That's what I'm saying. Bankruptcy would have been easier. I would have had a better credit score with bankruptcy than even doing what I had done by trying to pay everybody back. And so I eventually did it. And that's where I was able to get back into real estate again by 2015, 2016, after I rebuilt it. And I was able to be financially independent the second time by the end of 2016. But it was a hard battle, I'll tell you.
So I talk a lot about the investor's tuition, right? Because you can go to college, you're going to pay, what $50,000 to $100,000 in tuition fees that you can get taught your skill set, but there's not really an investing college, right? There's courses and boot camps and seminars and all that stuff you can go to. But kind of the school of hard knocks is where like you got a Harvard level investors tuition coming out of 2008, right? But
I got my PhD in poverty.
Yeah, PhD in poverty. Love it. But look at you now, right? Back to financial independence because the framework was there, the understanding of how money works. And you understood how it works, and then you were taught a new lesson on how it works in extremis, right? But
that's right.
Had you just been a person who had a lot of money versus a person who knew about money, I don't think you'd be in the same situation you're in today. That's why education is so important, is like understanding what these investments means, understanding how to read P&Ls, understanding your percents on return, your cash on cash return. All of those things are the financial, the tuition that's setting you up now, or I shouldn't say tuition, it's the education that comes from the tuition of School of Hard Knocks, right? And you're able to bounce back within the same lifetime multiple times, and now you're financially independent, right?
Yeah.
So I want to kind of dig into that a little bit more, as like, what you feel like you're stronger now financially, educationally from going through 2008?
Absolutely. Yeah. That's why, like, when you said, what's the best starting point for an investor? That's why I said, well, start with your own rental, because, I learned, like, if you don't have control of something, that's where it can go out of whack. Or if you don't have multiple exit strategies, like different possibilities, it's like, someone says, hey, I can get a short-term rental. Cool. Okay. You want to do a short-term rental? That's fine. That's like another business, right? But make sure if you get a short-term rental, it could also turn into a long-term rental in case the city decides to change things in the ordinances or whatever it might be, right? Like, you have some flexibility and movement, or you could sell the property. Like, that's one thing nice about single family. Even though I love multifamily because it's easier to scale, it's easier to buy those when you have more cash, because you don't want to be closing on little properties if you got 500,000 of the cash to deploy. It's really hard. Yeah. But at the same time, single family can sell a lot easier than trying to sell a fourplex, because you try to sell fourplex, you're only looking for investors, versus a single family, you have the whole market that can buy it, right? So yeah, it's definitely smarter. Cash reserves was a big one. Yeah, I'll tell you, like, in hindsight, had I had that money not in equity in my house, if I had that in hand, it would have been much easier than trying to, just load it up in the house. That's why, like, paying off the house, I think, is one of the riskiest moves people can make, unless you're already at the point where you're beyond financially independent, you're financially free, you have more cash burning in your pocket than you can deal with. Then, if you want to, pay off the house. But man, like, I learned that lesson so bad, that liquidity is so important. And so like, one of the changes I did now is, like, my wife says, I want to have at least 200,000 sitting in cash, right? Like, that's liquid, not tied up in any assets, not being invested, just in cash. Now, the problem with that is, if you put it in the bank, you're in point nothing percent. Yeah. And then you get taxed on your point nothing percent at the bank, right? So I made an agreement with her. I said, listen, if we're going to do that, let's do the strategy instead. And the funny thing is, she was actually trained as a Dave Ramsey counselor, right? So it was interesting that we ever got, hooked up and married. But, so I did something that Dave Ramsey would pee his pants over, which was, okay, honey, here's what we're going to do. I don't want to make point nothing percent on 200 grand because that's an opportunity cost to me. Let's keep 3/4 of that, earmarked inside of our life insurance policy. Because I have whole life that I use. I do like these high cash, low cost type policies. I was like, I'm going to keep 3/4 of that 150,000 inside there, making 5% tax free versus 0.05% in my bank. Right. So I'm keeping it there while keeping the other 50,000 in like bank or online savings accounts and things like that. So I can access it quickly, and doing that. So I can diversify it, still make some money on it while it's there. And then of course, investing the rest of the money, using that to make more.
The importance of liquidity is a big one. And I think a lot of people get hung up on what's the best strategy. Because me, like my neck starts itching when I got money in the bank, specifically because I just see it not getting a return. But every time, and like I took $100,000, put it into, went in with some partners, bought a 10-unit apartment complex to fix and flip, or actually to fix it and hold it. But there's a 6-month timeline on that. And we're coming up on that 6 months where I'm getting that $100,000 back. To me, that's an absorbable. Okay, I'm going to get that $100,000 back in 6 months, and then I'll have cash flow from that investment. It was a very good strategy, in my opinion, because that $100,000 is locked up. It's not liquid, but I get it back. And the only reason I want cash reserves, well, there's two big reasons. One, extremis, something happens to where I need money to float the businesses for a while because of a dip in the market, because of like COVID or something crazy happens to where the rents stop coming in for a bit or less rents come in. The other reason is just for opportunities to be able to take advantage of them, like this 10 unit. Sometimes, when some people say cash is king, some people say cash is trash. I think having cash in the bank with no plan is trash. Having cash in the bank with a plan is king, because we were able to bid out 7 other offers specifically because ours was cash only with a 7-day close, no contingencies. We didn't have to worry about contingencies because we already knew the property, we knew the location, we knew the market, we knew what it would be worth once we were finished with construction. And we go to the bank and we do a cash out refinance, and that puts the money back in our pocket to redeploy on different opportunities. And we have calculated into where we're only going to take so much where the property still cash flows, opens up another stream of income. So for my listeners out there, if you've got some money sitting in the bank and you don't have a plan for it, if you're not going to come up with a plan in real estate, stocks, bonds, mutual funds, whatever it may be, you're just going to lose your purchasing power to inflation. So I guess the better answer is come up with a plan on where to put it. Now, like you're talking about, I've heard a lot about the whole life insurance policies to where it's getting a return that at least beats inflation, right? Until you come up with a plan to where you can open up another line of revenue. But I originally, when I first started investing and I saw a 30-year mortgage, was under the assumption like this money's locked up for 30 years. Well, it wasn't, because my cash on cash return at 1.5% meant that I was getting my money back roughly between year 3 and 4, right? My down payment based on those percent returns. Or I could sell the property or do a cash out refinance. It's not as liquid as the stock markets, but I plan to get it back and redeploy it. Right. And I imagine you see kind of the same thing. Like you want that $200,000 because you've lived through 2008. You know what crap looks like. Right. But that $200,000 is still getting you a 5% return, which is on par with what inflation is going to be. I think the last couple of years, inflation's been hyper accelerated. So you've lost some buying power with it, but you've had that sense of security that said, okay, in a hyperinflated market, I probably need to have some cash reserves available in case things do go completely wrong. I want to be able to deploy that stuff to float the businesses. So cash reserves is something that I constantly battle with on, like, what's my plan for my cash, right? And how do you, like, other than the whole life insurance policy, with that $200,000, is $200,000 like your hard limit, or is it, do you allow it to dip lower for opportunities, knowing that you're going to build it? How do you kind of plan that?
No, that's kind of our base minimum. We can have more, at different times, and it's not bad to have extra dry powder in case of opportunities as well. So that's more just like for my wife's peace of mind type of account, right? But we have more reserves, especially if there's more dry powder. You're saying, hey, there's some extra money I might have for opportunities. Maybe there's something that's coming up. Now you don't want to do that chronically, right? You don't want to do that long term to where you never do anything. I have one client where he's got $900,000 sitting in cash and he's just sitting. It's like, dude, like it's time to deploy. You should have deployed months ago. We've had plenty of opportunities, plenty of money you could have made. Do something, right? But again, he's frozen in fear, and you can't let that take you over. So there's that balance. But no, we just keep that baseline, and that's for my wife. She wanted 1 year of expenses. She's like, I want 1 year of expenses that we just have there just in case income were to dry up completely. We would have that buffer. So is it overkill? Especially with the different income streams you have coming in, because we have more than enough income streams coming in where we're now actually have a new goal that we're about to hit, which is double our monthly expenses, right? Financial independence, when you actually can pay for your monthly expenses with a passive income, we're trying to now create it to be double. So we're like, hey, let's just crush it. Let's get even well beyond that, and just keep that passive income growing.
When you said double your monthly expenses, I thought meant like you want more
increase them.
Yeah. So 2 times
double
the
passive
income versus basically reduce your expenses by 50% or increase your income by 100, right? That's what you're saying.
Exactly. Yeah. If your monthly expenses are 10,000 a month, for example, then try to get to 20,000 a month of passive income. Something like that, where you have more than enough buffer. That's there.
So we just opened up our Facebook group, Middle Class to Millionaire, and the people inside the group are we call the gorillas. And I see a lot of people just getting into investing who, whenever we ask them, like, what would you do with $100,000 if you had it today? A lot of them would say they would pay off their auto loans, pay down their mortgage, all of these things, and then get to where they can start investing. What would be your advice versus paying down? Essentially, auto loans and mortgages are pretty cheap money versus the opportunity cost of not deploying it into an asset. What would be your advice to that person?
Yeah, my knee-jerk reaction would say don't do it, but it depends. It actually does depend. I look at everything from a cash flow standpoint, right? Like, what's it going to do for a month to month? Because that's the real reason why people want to pay off loans. It's not the balance that scares people, right? It's not the total balance necessarily. It's the ongoing monthly payments that they feel trapped with, right? And there's good merit to that. So it depends, because if you could invest and make more than that payment, like I see people with student loans, they'll say, oh, I got to pay off that student loan, and maybe it's $100,000, but they're only paying $500 a month, let's say. Well, if I can take that same 100,000, make $1,000 a month with that real estate property, why would I ever want to pay off that student loan? And I'm a good living example. I had my student loans go for 15 years before I finally paid them off, right?
Yeah.
So I do use a formula I call a cash flow index that I created during 2008 when I was in that real tough spot of how to measure, like, do I invest or do I pay off a debt? I'm not going to go into huge detail right here for lack of time, but I did do a podcast episode last year on the Chris Miles Money Show about it. But here's what it is simply. Like, I'm really just looking at the cash flow. If I could take that money, pay off that loan, would I make more cash flow than if I invest it, right? That's really kind of what it comes down to. Now, if it's low interest, I might be okay with it. Like car loans, auto loans, I generally don't want to pay off. Student loans, I don't want to pay off. Credit cards, sure.
Yeah.
We actually had a client that came through our we have like a consulting type of thing. We do like anti-financial advising, right? Where we actually help create a plan using alternative investments versus using mutual funds, right? And they came to us, they said, hey, we want to get into real estate investing. We've got some cash, help us out. And when we looked at their situation, we're analyzing all their cash flow because we're looking at income and expenses and everything. We saw some of the loans that they had, and we said, you know what we're going to do instead? We're actually going to pay off some of these loans with some of that cash instead of investing it, because we can actually free up $4,000 a month on the debt side. So for them, we actually did that first. We did some refinancing and stuff too, so we weren't all paying off debt, but we freed up $4,000 a month. That was way more than they would have made. We were looking more like $3,000 a month in total with all their money to make for the passive income that year. Well, now we freed up $4,000 a month, and now we can still make them at least another extra $2,000 a month which means now their increased cash flow is $6,000 a month just with less cash, right? So that's why I say it depends. But for the most part, like, do not, without a proper plan or looking at those kind of things, don't pay off those debts first, because it might be the thing that costs you your freedom later on.
Yeah, and that's where Dave Ramsey really does come into play, because he's got some very good methods to get you to net zero. I think if you're in debt, I think Dave Ramsey is a phenomenal source. His snowball effect, where basically you chip away at the debts that you owe, but you start getting to your mortgage and your car notes, you're looking at like less than 5% interest. There's plenty of investments out there that can earn more than 5% interest.
That's right.
If you've got a credit card that's 12 to 15% interest on that, and you've got a $20,000 balance, I would say that is your primary. You pay that down right now, because your chances of finding a passive investment that are going to make more than that, the risk of you taking that investment and making less means that you could have guaranteed paid off 12 to 15%. And then now you don't have to pay that. Now that say it was $300 or $400 a month, can go into your savings for your next investment, and you flip flop it. So again, I agree with you 100%. Dave Ramsey will get you out of debt, but I wouldn't say get you financially independent. He focuses a lot on your standard, your middle class mentality of don't get into a bunch of debt. Don't get into a bunch of expensive debt. I know he does have some stuff that goes beyond and teaches people investments and stuff, but the premise of what he was built on was getting people to net zero. Like how do we get you out of debt? And for me, if I've got a $200,000-$300,000 mortgage, no way am I putting $300,000 to pay down my mortgage whenever my mortgage is at 3.5%. I can go find an investment that pays me 15% and make 3 times my interest payments. And then I can use that investment to pay if I want. If I only want to do 1 or 2 investments, don't want to be a professional investor, I can use the income from that investment to hyper pay down my mortgage if I want to. I see a lot of people get tied up on that. The house note is the biggest monthly expense that every middle class American has, and they want it to go away. But the reality of it is, if you buy another house that's not your primary residence and it's cash flowing, well, if you buy, how many homes can you afford that make money every month? You can afford as many as you can put the down payment for. Right. So it's not an expense anymore. It's an asset. And I want people to start getting their head around that, because it really is the mindset shift that people have to go through to really start their investing career. So that's great, man.
Sure.
Chris, do you have anything to add to that before we go into our questions that I ask every guest?
Yeah, I mean, I'll tell you, like, you're right. Like Dave Ramsey, and I wouldn't even use his method of paying, the lowest balance or the highest interest rate card. Don't do that at all. That's why that cash flow index is more important, because it's really about how much cash flow can we free up if we're going to pay off a debt. How can we pay the least amount of money to free up the most cash? Yeah. So my cash flow index, the simple equation, if you ever figure it out, is balance of the loan divided by the minimum monthly payment, right? So if you have a $10,000 credit card and it's a $200 a month, 10,000 divided by 200 is an index of 50. Now, let's just say you have a $10,000 car loan, even if it's lower percent interest, but the payment is 500 a month, right? Well, 10,000 divided by 500 is 20. Now, just looking from a common sense standpoint, if you're like, all I have is 10,000 bucks, so I pay off this $500 a month car or a $200 a month credit card, common sense will tell you the safer route is to pay off the $500 a month car loan, even if it's lower interest, because that gives you more options. You can always pay extra to the credit card, but at least you're only stuck with a $200 a month payment versus a $500 a month payment when you do it that way. Ramsey would say, no, pay off that credit card, because that's going to, have the highest interest rate. That's in real life, that's not going to work well. That works great in a calculator, in a nice little, test tube baby, of a life, but that doesn't work in real life, where you have all these variables and things that can happen that can throw you off course when you're trying to hit your financial goals.
And that makes sense, because car loans are typically 6 years, but it's your monthly requirement to pay it down, right? Which if you hit rock bottom financially, that that amount is going to hit you a lot harder than the minimum credit card payment. So I understand what you're saying with that.
Yes.
That makes perfect sense. Creditors will let you pay the minimums for life, right? Like, so
Yeah.
that monthly amount that you have to pay is a lot less. So might as well get the car loan out of the way. And then now you've freed up $500 a month to start putting towards your minimum credit card. Yeah.
And that's what you should do a 30-year mortgage. That's why a 30-year mortgage, even if you could pay more, don't do the Dave Ramsey method of doing a 10 or 15-year mortgage. That's risky. Even a bank, think about it. Banks look at you from a risk standpoint too. When you try to get a loan, what's the thing they look at besides a credit score and cash reserves? They're looking at debt to income ratio. They really want to know how high are your monthly payments compared to your income. When you try to aggressively pay off a loan by force, by doing a 10 or 15-year mortgage, they actually don't like it. I had a client in San Diego, in your area, right? He actually was denied a 10-year mortgage. He was trying to get down to a 10-year, even though it was lower interest, and he thought it would be less risky. The bank says, no, we won't do that. So they said, we'll let you do a 20-year because of his debt to income ratio.
Yeah.
I told him, I said, don't you dare go to the 30-year. It's the same interest rate and lower payment. Here's the crazy thing that people don't realize, right? Is the interest you pay on a loan is simple interest, while the interest you earn on money is compounding interest. They're not the same. So like you mentioned, like, you just have to beat the interest rate. Well, let's just say that your interest rate on your mortgage is 3.25%, right? Well, you don't have to beat 3.25% to beat it. You could actually be earning 1.6% in a CD and make more money over 30 years than you would paying off that mortgage. So what I mean is this, is that if you have a $300,000 mortgage at 3.25%, you will pay $170,000 in interest over those 30 years.
Okay.
The crazy thing is if you earn 3.25% in a CD, let's just say, for example, on that 300,000, say you have the 300,000, you could pay off the mortgage today, right? And that would save you all that interest, that 170,000. But instead you said, instead of paying off my mortgage, I'm going to put that 300,000 in a 3.25% savings account. That 3.25%, even though it's the same as your mortgage, doesn't earn 170,000 of interest over 30 years. It actually earns about $500,000 of interest over 30 years.
It's compounding.
Because it's compounding. See, simple interest goes down over time. If you ever see those charts on your interest you're paying, well, compounding interest does this. So you only have to earn just less than half the interest rate to beat it. On a 5-year car loan, you just have to earn exactly half. So if you have a 3% car loan, you just need to earn 1.5% of that money that you would have used to pay the car. And so think about it. I mean, if you earn 20%, by the way, that same 300,000 example on that mortgage, if you earn 20% over, actually not even 20%, sorry, 15% over the next 30 years, you'll make almost $20 million in interest.
Nice.
It's 20 million versus the 170 it cost you. Do you think you would give a crap about the 170,000 if you're going to make 20 million for 15%, which we know in the real estate game, especially with all the different returns you can make, especially when you're buying with leverage, you can definitely do that. So awesome. It seems too good to be true, but it's not. It's just math. It really is. And that's the biggest thing I want people to understand is that even when we try to figure out cash flow and everything else, we try to make a minimum of at least double-digit returns with any investment we do. Well, it's just math. You got 100,000, great. You make 10%, drop off to zero, you make 10,000 a year. That's income. If you want a 100,000 a year lifestyle, great. Get up to $1 million. That's the simple math. Drop off to zero, you make 100,000 a year. If you make more than 10%, then great. You need less money to do it. But if you try to make 100,000 a year from the stock market, you're gonna have to have at least 3.5 million today, not counting inflation in the future, right?
Awesome, Chris. Well, hey, I want to move into the final 3 questions I ask every guest now. And the first question is what's been your biggest mistake in your investing career, and what'd you learn from it?
The biggest mistake was really believing that I'm awesome. Not staying humble. I mean, really, you got to stay humble. You got to really look at all the areas, like what can go wrong. If you always look at the good and just the positives, but not the contingencies that go with it, you're not really an investor. You're just a gambler. And so if you want to be a true investors try to take the lowest risk possible, manage and get their risk to as close to zero as possible so that they get the maximum gains with the lowest risk.
Okay. All right. And what's been your biggest success in investing?
Really focusing on like what we talked about earlier. One, having good cash reserves just in case, having that little safety net, and creating the safety net of multiple streams of income. Like I don't just rely on one passive stream of income. I don't rely just on my business revenue. I mean, I don't even need my business technically, but I don't rely on just any one stream of income. I want to make sure that I have multiple streams coming in. So even if something goes wrong, even if with my rental properties, if something goes wrong, I've got other streams of income coming in to diversify me and keep me safe.
Awesome, Chris. And the question for the Gorilla Estate podcast is, what really bruises your bananas in the world of real estate? Like what information that you hear that's out there that you disagree with, or you want to set the record straight, is your opportunity to do so.
Yeah, that you should be buying and managing your own properties in your own backyard. I mean, that's the thing that drives me nuts. Like I don't mind investing, in a place that I've never seen before. In fact, sometimes I'm actually less emotional about it. Because if I go and see a property, walk through a property, I can get caught up in the potential of it, right? But if I'm like looking at just the facts, like here's what it is, here's what's going on. I can see the videos, I see the photos, I can see the home inspection reports, everything else. I can be a much better judge of that property in some ways. It doesn't mean it's infallible, but it drives me nuts when people say, "Oh, I invest in real estate," and then the return on equity is so low. Just like, I have a client in California, another one around San Diego, and his property has 700,000 of equity, but he makes 200 a month of profit. So his return on equity, that, $200 a month, 2,400 a year on 700,000 is not a great return.
Yeah.
It's like, man, we can move that somewhere else out east. That's even worst case at 10% cash and cash, that would still make him almost about 6,000 a month versus 200 a month.
Yeah, Jesus.
I was like, sell that sucker. I don't care if that was your first property and you loved it. Get rid of that sucker, move it elsewhere, because you're going to make way more money elsewhere.
All right, Chris, I appreciate it, brother. So now, if people want to get a hold to you, if they want to listen to your podcast, go ahead and tell them how to do so and where they should go.
Yeah, they can go to the Chris Miles Money Show. You can find on iTunes, you can find on YouTube, all that kind of stuff. Or you can even go to our website, moneyripples.com, and you can even get lots of information from there as well.
And your calculator's on the front of your website, correct?
Mm-hmm. Yeah, we got a passive income calculator on there that can show you like how much passive income you can create in the next 12 months based on your situation. It does it kind of few short questions, but can figure out almost within a few $1,000s what you can actually create. And then there's even like a playlist on that infinite banking, that whole life, insurance thing. I have a whole playlist on how those things work too.
Nice. And then you have the free ebook, Beyond Rice and Beans. Why don't you give a quick synopsis of what and why the title Beyond Rice and Beans?
Well, obviously we've been talking about Dave Ramsey, right?
Yeah.
He's always talking about living on rice and beans. Well, most of us don't want to just live on rice and beans.
No.
So I teach people, hey, you don't have to be cheap. You can actually live a life still and become financially free. And so it's actually about what happened to me during the last recession, right? All that, going in the hole, people always ask, well, Chris, like, how'd you get out of that hole? Like, what did you do? What were the strategies you were doing? Well, I was freeing up cash flow. I was finding money and getting creative. And I actually took those same strategies. I've helped hundreds of clients on average find $34,000 a year. So that book basically is a very short read. I'm not a big writer, so you can pretty much read it in about a half an hour, but it gives like the 7 biggest ways that myself, as well as hundreds of my clients, have found and freed up money.
Yeah, I've read a couple of books that kind of push that, like, you got to live like no one else so you can live like no one else. I'm like, one of the first things is like, cut out your Red Bulls, cut out your dip, cut out drinking, don't go to the yes. No.
Latte factor. Yeah.
Yeah, man. Yeah, the latte factor. I remember that. Like, no, I like going and getting me a coffee on the way to work. Yeah, it's $5. But if I'm worried about $5 every single day, I get that stuff adds up, but I could take my money and invest it in an asset that gives me my lattes for the year, like quickly. And that's, I say this on probably every episode now, but I can't not talk about the one thing that Kiyosaki says is not we can't afford it. How can we afford it? And that first duplex that I bought, I remember looking at, I wanted to buy a brand new vehicle, and everybody, the way that I was raised, do not buy a brand new vehicle, buy a used vehicle. Well, I had just bought a used vehicle that broke down on me. I basically buying a used vehicle in my mind is now inheriting somebody else's problems, because there's a reason that vehicle got turned in. They didn't want it anymore because it wasn't fitting their needs. So I wanted to buy my first brand new truck. It was $40,000. I also wanted to get into investing, which was it was a duplex for $40,000, and good luck looking for one nowadays. But I remember listening to Kiyosaki's podcast. It said, not how can I, or not I can't afford it, how can I afford it? And I was either going to put $40,000 towards a truck or $40,000 towards a duplex. And when I looked at that duplex, the cash flow from the duplex itself was the exact truck payment. I said, oh my God, I can buy this duplex and it pays for my first vehicle. And the funny thing is that it paid off my truck in 5 years. And then I sold it, and my profit from that was 45 grand, which is what I was able to was the price of my wife's car, which I financed the car, because at that point I learned, the power of leverage. But that decision, had I just bought the truck, all cash, $40,000, I'd be sitting right here with just a truck, no investment. I wouldn't have got started. So that's kind of, to me, the power of, I'm going to pick an asset and use the income from that to give me the lifestyle I want. You know what I mean? Not the other way around. I get the lifestyle I want where I can't afford assets. Assets will free up your lifestyle. You don't have to give up everything you want. Just ask yourself, how can I afford it? Well, it's likely investing. Does it make sense? So that to me is kind of the difference in the two books. And I love Kiyosaki, all of his stuff from an early age. Actually, I got my daughter reading it now. She's 12 years old, and she's already started her own sticker business, and she's crushing it. So these concepts are simple enough for a 12-year-old to understand. If you're an adult at all, you should definitely be able to understand them. Cool.
Hey,
well, Chris,
12-year-old.
Yeah.
You can do it.
12-year-old starting her first business. She's not really paying taxes, doesn't have a business license yet, but she's definitely hustling. Well, Chris, man, that's it for the show, brother. I appreciate you coming on. I hope you consider me in your network. For everybody out there listening, Chris is the Chris Miles Money Show. Give it a listen. 588 episodes as to today. Probably by the time this launches, there'll be over 600 episodes. So I appreciate you coming on, man, and hope to see you again.
Looking forward to it.
Thanks for listening to the Gorilla State Investing Podcast, where we give you the ground-pounding truth about what it takes to be successful in real estate. Learn more at realfocus.org/Gorilla State Pod.